Welcome everyone to our non-QM monthly series. Excited to be coming into you today from the great state of Utah. I'm out here at the Utah Mortgage Professional Show. And this is just a great topic in general, and it comes up frequently even while I'm here at the show. But so many people are not able to get loans closed because of what we call a non-warrantable condo and things that happen with condos. And so we welcome all those that are in attendance. We want to walk you through how you save the clients that are wanting to get into these homes, whether it's a purchase or a refinance. So I have some great people joining me on this call. Again, my name is Don Chiesa. I oversee all of our non-QM business and manage our Western division. And so I've got some great people. Cecilia Estrada, who is a longtime non-QM expert. She is our business development manager for all things non-QM, and she's going to be the host of our call along with myself. And then we're lucky to have Gretchen Rowe, who is the longtime team member here at Newrez and head of our condo production. We have one of literally, I've joined Newrez recently and know that we have one of the best condo teams in the industry. And that's because of Gretchen and her team and what they do over there. So I thank her. She's our subject matter expert. We're glad to have her on the call so we can talk about what is a non-warrantable condo. We have so many misperceptions out there, and what can we do versus others? Because I think some people say they do things and they don't. We do a lot of great things here, but we want to go into what those are. So I'm going to turn it over to Cecilia. Cecilia, thank you, and welcome to the webinar.
Thank you so much, Don, and thank you everyone for joining us today. We're super excited about today's topic. As you know, over the past few weeks, we've been going over different products, especially focusing on our non-QM series. And today we are bringing a super hot topic, which is condos, but not just any condo, non-warrantable condos, right? That's everyone's headache when they are dealing with condos. They're just waiting and wondering, is this going to be warrantable? Is this going to be Fannie Mae approved? So first and foremost, let's focus on what is a non-warrantable condo, right? So it's a condo that's not meeting the guidelines that are set forth by Fannie Mae or Freddie Mac. And there's a lot of things that go into that: single entity ownership, investor concentration, right? The amount of the deductible for your insurance. There's a lot of things that will not meet those guidelines. So a non-warrantable condo is a condo that Fannie Mae basically says, we're not going to do this one. We're not going to move forward on it, right? But of course, when you've worked so hard to get your buyer to the closing table and they're buying a condo, you're not going to tell them, hey, sorry, Fannie Mae can't do this one. You've got to find a way to get it done. So having products that focus on these types of properties, non-warrantable condos, is exactly what you're looking for. You need that ace up your sleeve to have something that you can pivot into. So that's what we're going to be exploring today. And first of all, I do want to give you a quick little side-by-side of some of the things that we look at when it comes to condos, right? So we have some of the guidelines that Fannie Mae looks at. You'll see those at the top left where it says warrantable. And then what we look at, which are basically the same guidelines that they're looking at, but we've just expanded upon them. We've given you a little bit more space to work with so that you don't feel so restricted if something's not quite meeting what Fannie Mae was requiring. And we've got our great condo VP here, Gretchen. I have her group email, which is our condo team, there on the bottom right-hand side. You'll see it says project review, and her team basically overviews all the properties that have a governing board. So whether it's a regular condo, non-warrantable, a condotel, or even co-ops, right? Because we do co-ops in New York. We have 5 boroughs that we're approved in. So Gretchen, there's a lot of little things here that we're looking at. And I think one of the biggest ones that people usually miss or don't really think of is the insurance deductible. Do you want to talk a little bit about that and how we came up with saying, hey, you know what, let's expand it because this is becoming a real issue?
In the condo space, HOAs are doing a lot of creating things to keep their cost of their insurance down. In addition to, the insurance market doesn't necessarily have the insurance available that is warrantable in the condominium space. So what the agencies require isn't always available in every market. So we're seeing a lot more issues than we did previously to probably really late 23, but 2024, it kind of exploded where we're seeing a lot of excess deductibles. In particular, we're seeing per unit deductibles where we had never seen those before. Now we're seeing them on like water and sewer and even just across the board, all perils. And then we're also seeing excess deductibles on per occurrence, like named storm or wind and hail. We're seeing exclusions for those kinds of things and a lot of other things like sublimits, hurricane sublimits we're seeing, and even just coverage sublimits in across the nation. Different geographical areas have different challenges, but these are impairing our ability to lend in condominium and co-op projects to the point where we're now, unfortunately, under the warrantable space, we're declining about 1 in 10 projects at this time.
Wow, that's a huge amount. That is a huge amount. And so I think definitely this space, this non-warrantable, is definitely needed, right? So that we can save some of those and push them through and get our deals done. So thank you, Gretchen. And yes, team, I know that there's always questions. We are going to go over that. We're going to go over our condo checklist. We're going to go over some of the do's and don'ts, some of the things that we can and can't do. But again, this is just a quick little side-by-side view so that you can see what are some of the things that we focus on. And we're really looking at what Fannie Mae already looks at. We're just giving you a wider view, a wider lens, so we can capture more deals. It doesn't mean that we're going to go rogue and just say, yeah, any old condo will do, right? They don't have to pass any inspection or anything like that. I think a lot of people have that misconception that non-warrantable means doesn't matter what it is, we're going to do it. So we're here to kind of give you a little bit more of those insights. So we're going to move into one of the more important parts of getting that condo approved, right? Which is not just, the initial part that you're used to doing, which is making sure that your purchase contract gets approved, that the seller's good, but we've got a checklist for our condos. And there's a lot of things that we're going to look at here. So we're looking at, first of all, whether it is a condo, right? What it meets in terms of the size. Size is always a huge thing. I did want to ask you about that, Gretchen, because we do have a minimum 500 square foot requirement per our guidelines. But I think in certain areas, sometimes condos are a little bit smaller. Can you speak to that as to how we go about that, how we, kind of move that condo forward?
Yes, I first want to kind of echo what Cecilia just said, that just because a project doesn't meet warrantable guidelines doesn't mean we have expanded eligibility in the smart product space. So we're going through where we do have expanded eligibility at this time, and it's not in every space. So for the minimum square footage, so the project size, when Fannie Mae, Freddie Mac a long time ago used to have a minimum 400 square foot. They eliminated that. We've added back in a 500 square foot minimum for the smart products. Why have we done that? The reason is that in a lot of the condotels, I'll tell you what we're looking for when we're seeing that, is a lot of condotels, we kind of see these, what I would call a motel conversion. Think like a beach motel. You have entry levels, you park right in front of the units. The entries are on the first floor, the second floor. They're really just studios, and they throw in a dorm fridge, a microwave, and a single burner plug-in stove, and they call it a kitchen. We will not lend in those projects. So that's where we put that 500 square foot minimum in there. We will make exceptions to those. So for example, maybe there's a ski resort in the mountain areas that was built as a condo and they have multiple different floor plans. Maybe they have a studio floor plan that is under 500 square feet. And then they have a 1-bedroom plan, maybe even a 2-bedroom, maybe even a 3-bedroom plan. In those cases where they were built as condos, they have a true kitchen, even though they're a studio and they might be under 500 square feet. Where not all of the units are under that 500 square feet, we probably would make an exception to do that unit, assuming it met all other guidelines. So we do make exceptions to this. It's really just a mechanism for us to avoid lending in those motel conversion projects. We're not interested in lending in those.
Yes. And I'm so glad that you brought that up because you're absolutely right. A lot of times I look at pictures and appraisals and it's not a real kitchen, it's a kitchenette, right? It's just a
If that,
microwave and a little stovetop burner and a tiny little fridge. And it's like, that's just like you said, that's a motel. That's not even a condotel, like a hotel or an actual kitchen. So I'm glad we're seeing that distinction there. And what we're really looking for, it sounds like, is like a true functioning kitchen, something that, again, it doesn't look like a motel. It's something that you're owning. You're just not, just that little parking space and your little door, right?
so what we're looking for, if you think about it kind of the way you're saying it, is that we're looking for a place where somebody could realistically live there full time as their primary residence. Now, I know a lot of people are going to say nobody lives in a condotel full time. They're mostly second home and investors. We are seeing a big change in that. So I would say maybe 10 years ago, we'd see a lot of projects with no primary residences. Now it's probably up to like 13 to 15% of the condotel units are very commonly primary residence. So we do have people living there full time. And as a risk for us as a lender, why do we care? If we acquire that property through foreclosure, or that borrower wants to sell their property, or even if they have it as an investor, maybe they retire, they have a change of circumstance and they want to live there full time, we are really strict about the borrower restrictions. The borrower must be able to live in the property full time as their primary residence in every unit in the project, not just the subject unit. So I'm going to just add this because it's came up twice in the last month, is timeshares. If there's any timeshares in the project, the borrower can't live there full time. They can only live there for their unit. I'm sorry, for their whatever week or 2 weeks.
Yeah.
And even if it's not our unit, that project is not eligible under our condotel expansion because they have to be able to live. Every unit must be able to be a primary occupants with no restrictions, no mandatory blackout dates.
Mhm. And so it doesn't even matter if we're doing a DSCR loan, for example, where it's investment, they still have to be able to live there.
Correct. Because it might
For
change.
a long period of time.
Right. It might change. The circumstance might change. We might acquire it. It also limits who buyers could be, whether it's our unit owner selling it or us selling it out of a foreclosure.
Yeah.
So it's an additional risk that we're not including in this product.
Perfect. That's a good, I guess, kind of expansion on what we know, because we're always just thinking, why don't they allow timeshares, right? So now just kind of seeing behind the scenes why those guidelines are there. Okay, so let's move on into a little
One
bit
quick
further.
question before you move on, because I know you addressed the minimum 500 square feet, but one of the things you called out, Gretchen, is the one bedroom. So there's been a couple questions in the chat around what some of these properties have studios. Is that just something that we don't allow?
We do. So again, that would be an exception. So what we're looking for is, are all the units studio? Is this a motel conversion? Was this built as a condominium and the studio is a functioning full-time residence unit with a full kitchen that somebody would live in year-round? Or is it one plan type? So for an exception, so we require an exception for under 500 square feet. And that exception includes for studios. And we do make those when it makes sense. So I'm trying to explain when it makes sense is when it's part of a project that was built as condos and it's one of the multiple floor plans that are offered in the project per the building plans, and not the entire project. They're all 350 square feet with not real kitchens, the motel conversions. So we won't lend in those types of projects. But if it's, I see them mostly in the ski resort areas where they're very small, but they're a studio, they're fully functioning. They could be under 500 square feet. And then they have other bigger plan types. We will usually make an exception for those, assuming the project meets all other guidelines. So for the studio, yes, we will make an exception.
Okay, great. Any other questions there, Dawn, that are popping up that you see?
You're on mute, Don.
The only other one that's popped up a couple of times is I know it's common for co-ops in New York, and that's why most lenders only stick to New York, but there's been a couple with areas that are outside New York and maybe why we don't do them. And I think it's just because of commonality and what we see. But if there's any additional comments there, Gretchen.
So why we restrict the areas we do co-ops? Is that the question?
Correct.
Yeah, just to New York.
The reason we restrict it is because we have to have closing attorneys, and we have to be able to service those loans and obtain those closing docs. And to set that up, it's actually by county. And then the project has to be marketable. We have to be able to demonstrate a market for those projects with other similar projects in the market area where the appraisal comes in with condo.
All right, so let's get into our checklist that we look at when we are submitting for an HOA approval or a condo approval, right? Because there are a couple of things that we look at. This is a snippet of the checklist that we have that everyone here has access to, so you can see the differences, what we're looking at, the differences between Fannie Mae and Freddie, which is right in the center, and our smart products, which is our non-QM product line, which is the expanded version where you're going to get the non-warrantable condos. Of these, and there's a lot of them listed here, right? Commercial space, single entity ownership, things like this. I think probably the one that comes up the most that people have questions about is the investor concentration, right? There's a lot of, properties that are lived in by tenants, not the actual owners. Is that going to be okay? And if you take a look at that line there for investor concentration, we actually removed the limit on our non-warrantable condos. So there is no investor concentration. So whether most of the condos are lived in by tenants, not the owners, it's okay. We're okay with it. It doesn't necessarily apply, right? The other one that comes up quite a bit is the second one listed there, which is single entity ownership, right? And that is when there's one company or one person who owns the majority of the condos in that complex, in that HOA. So that is something that is kind of like a sticking point. That's something that Fannie Mae does look at very closely. And so what we've done, because it's usually about 20% that they allow, what we've done is we've more than doubled that. We took it up to 49% owned by one person, because I think, Gretchen, and correct me if I'm wrong, once it goes over that, then it's kind of like a monopoly, right, by that person or that company.
That's the concern, is that entity would control the homeowners association.
Yeah.
And that's why we go to the 49%. So I
Yeah.
get a question a lot asked for me is, would we ever go over the 49% single entity? And the answer is yes, we do make exceptions for that occasionally. Mostly what we're going to be looking for is anytime we have a single entity ownership, we need those legal docs. So we need those declarations, we need the bylaws, because we want to see how the voting is controlled and the percentage of interests are set up. Just because they own 49%, it might not be 49% of the voting interest. And sometimes the voting is 67%. So that could kind of help us offset those risks. In addition, when we're usually seeing those higher percentages, they're often conversions where we still have a single entity who's selling off units that were maybe previously tenant occupied. And they're usually trying not to flood the market. They don't want to vacate every unit that they're selling. They sometimes kind of do them in waves to not flood the market and keep it competitive. And we can work with single entities who are selling their units by reviewing what they have vacant and listed for sale, what their sales velocity plan is, their marketing plan is, and we can monitor that through doing loans in that project. So we do make exceptions to that under certain circumstances. If you have that situation where a single entity in a conversion is selling off the units and they are vacating, like maybe leases that expire, and listing them for sale, then let us see it. Get the legals for us. If you can, get us a questionnaire, especially if you have a very motivated single entity who's willing to work with us on communication and documentation.
Perfect. And I think people love to hear that we will at least consider it, and exception is a possibility. Because that's really what they're trying to do, is they want to push as much as they can to get that buyer that home, that property. So if we can work with them in any way, I know that our audience loves to hear that. So let's move on to a couple of the other things that we have on that list: reserves, litigation, stuff like that. I know one of the biggest questions that we get asked is, if there is litigation, is that going to be an issue? And you actually do see it there on our guide, on our checklist, that it's case by case. So we're going to get into that a little bit further down the line, a little bit deeper, but it is case by case. So it's something that we may consider. I want to make sure people know that a lot of these things, like Gretchen said, her team will look to see if there's anything that they can do to kind of put you into a space where you can possibly get approved. Okay. Now there is a difference between non-warrantable condos and condo-tels, right? So the biggest difference being that the condo-tel is part of a hotel or something that was converted from a hotel, right, Gretchen? And they usually have like a service. What do they call that? Not like a bellhop, but kind of like a 24-hour service or something like that, right?
They
Sort
can.
of
I mean, they're not always converted. They're often built that way. They're
built that way.
with the sort of in rec areas where there's a lot of transient rentals in the areas, and often they have hotel services. Not always. They don't always have hotel services. They're usually built as condos. They're not usually built as hotels.
Okay.
And they look like a condo in the declaration in every way, but we're really aggressive in this space. We're really going after these condo-tels. I just want to point out a couple of things that we so the main reasons, I think the easiest thing to do would be to tell you what we will do and what we won't do.
Yeah.
So what we do allow under this condo-tel product is we do allow that up to 50% commercial in this space. So that's a really big part of it, because a lot of times they are combined with commercial space. Maybe the commercial space is a hotel. So we do see that sometimes, and we do allow that. The other things that we will do is we allow those mandatory memberships, those memberships for like beach clubs, water parks, ski clubs, things like that. We do allow those also under this product with restrictions. So we, the most common reasons we're not able to approve a condo-tel is, I'm going to go back to what I said earlier, is because the borrower does not have the right to occupy the property full-time as a primary residence. So that's the number one reason. The other reason is the rental pooling. Now I'm going to tell you, we are really loose on what rental pooling is. What we're looking for is the HOA running the rental operations through the HOA budget? Are they taking the income and paying the bills from the rental of those properties? Is, if I own a unit in the project and I rent my unit, am I working with the HOA? Or is my contract, if my unit's rented, I'm the one who gets paid and I pay the management expense fees, perhaps to an on-site management? So we allow on-site management. We even allow, if they're required to use a specific management company, even if that management company is on site, we allow all those things. So bottom line, what we're looking for is if a unit owner is renting his or her unit and their agreement needs to be with the management company, and the income and expenses of that cannot be ran through the HOA. So we're going to look at that HOA budget. So again, we need all the legals and the budget for every condo-tel, we need that. One thing I will say we allow is a lot of condo-tels where they're primarily second homes, they do have an amenity use fee. So for the unit owners who rent their units, guests are harder wear and tear on the amenities. So they do charge the people who rent their units to an amenity use fee. So we do allow that for a certain percentage of the income. And that's where that we restrict that non-incidental income to 15 to industry guidelines, to 10 and 15%. We don't have that expanded eligibility where we allow the 25%, because we don't want to see that being what the HOA is relying on to pay their bills, because rental markets can change. So we don't want to see them relying on that income to pay their bills. And I don't know if I got that confused or if that makes sense.
No, it does. It does. And I think what you just mentioned about the condo-tels is really something that a lot of people don't know. They don't really know what the difference is. They just think, okay, I'm just going to be living in a hotel, basically, right? They don't really know all the little things that you mentioned, like, for example, the timeshare stuff. It's still part of it. You can't have a timeshare. You have to be able to live there for a while. So I know one of the things that people usually ask me, it sounds kind of funny, but like, hey, when I go to Vegas, that's the first thing I get asked. Do I want to go see a timeshare? Can I buy that? Can I live there? But because it's a timeshare, no, you wouldn't be able to. You'd have to buy something, like you said, that was constructed as a condo-tel from the beginning, or that was correctly converted, right?
Yeah, so it's in the legal documents generally. Generally, it's in the legal documents, not always. So again, I just want to repeat, if any of the units are timeshare units, that project is not eligible, even if the subject unit is not a timeshare unit.
Exactly. Perfect. And moving on to some of the stuff that people were usually asking us about, and I'm sure that Dawn will see a lot of this in the Q&A, because these are probably the biggest, most popular questions that we get, right? Surrounding the deductibles, surrounding the cash value or the cost value, sublimits. So I'm going to let Gretchen kind of touch on each of these, because these are some of the biggest questions that we typically get.
Okay, so we kind of already talked about deductible. We have
Yeah.
the per unit excess deductibles and the per occurrence deductibles. The per occurrence is on the master policy, where maybe for a hurricane, their deductible is 10% across the board. It's not per unit, it's just across the board. So we do allow those in the smart space. We do them on a case-by-case basis. If we see a lot of other risks in that property, we might not allow it, but I will tell you that most of the time we are allowing those. We offset it with the requirement for the borrower to carry coverage for their portion of that excess deductible on their homeowner's policy. We do the same thing for the per unit deductible. So we are allowing those in the smart product space. Actual cash value versus replacement cost valuation. Actual cash value, if you don't know, is a depreciated valuation. It's based on the age of the item that's being insured. We see it a lot. Where again, that's another insurance crisis thing. Roofs used to always be insured to 100%. Now we're seeing a lot of roofs are not insured to 100% unless they're maybe under 12 years old. Even though you have 20 and 30-year roofs, they are not insured if they're over 12 years old. They are a depreciated valuation based on the age of the roof. That is not acceptable. We don't currently have a solution for that. We don't allow that under this product, but we anticipate having a solution for that in the near future, I would say before the end of this year. So currently, if it has ACV on the roof, we do not have a solution, and we do not make exceptions, but we're hoping to have a solution for that soon. Can't promise that. Sublimits. So hurricane sublimits are the biggest ones we're seeing, where maybe the property is insured for $12 million, but there's a hurricane sublimit for $5 million. So if there's hurricane damage and a total loss, they'd only be insured for $5 million. Again, we do not have a solution for that. We are still not able to do those under this product, and they are not warrantable either. So we don't have a lending solution or any products at Newrez that allow for the sublimits at this time. And I don't anticipate that one being allowed in the future. I'm on insurance calls industry-wide all the time. I'm like speaking in a couple of industry meetings and things like that. I think that what I'm hearing, and if this gives you any hope, that these are huge challenges right now in lending insurance. Like I said, 1 in 10 projects were declining because of insufficient insurance. I think what I'm hearing from the industry experts and from insurance experts is that we're anticipating maybe in the next 2 years for this to kind of settle down. Like the increases are already starting to settle down. We're hoping for guideline changes to kind of catch up with the insurance changes. And sorry, I'm supposed to be in another meeting. Let me tell them I'll be a few minutes late. So I'm hoping to see those change and those challenges get better over time. I think we're over the hump of the worst part, and it will continue to improve with guideline changes and the insurance industry settling down a little bit.
Yes. And I think the best part of everything that you just mentioned right now is that we are solution oriented. So we are looking for solutions for these issues. We know that they are issues that are plaguing a lot of our condos. So hopefully, like you mentioned, with the ACV versus RCV, maybe we'll see something there by the end of the year. And you are looking at those sublimits, which again, for the areas that do get a lot of that hurricane damage, we're looking to see what we can do. And hopefully in the next 2 years, we're able to get there, right? But this is something that's industry wide. It's not just us as a Newrez lender. This is something that's affecting all lenders. These are things that are affecting us entirely for collateral. Okay. All right. So let's move on into what we can do here with our, whenever we have little things that come up, right? Like deal killers. People are always wondering, okay, what about this? What about what about my deductible? It went over the 5%. And we did have a slide that said, that 5%. What about if there's a dispute? What if there's litigation? A lot of those questions are going to be answered in the actual form that you fill out, in the actual questionnaire, right? It does tell you that certain litigations we will do case by case. We can go above the 5% deductible case by case. Usually, I think the max that we would go to is 10%, right, Gretchen?
That's kind of, again, that's kind of like our guideline. Do we make exceptions? Yes, we do. We're more likely to make an exception on a per unit deductible where the borrower can cover the exposure than we are on a per occurrence deductible.
Yes, yes. So I think what we really want everyone to know is that although we do have guidelines set forth for our condos, it's not always black and white, yes or no. There are many times and many areas of that entire condo approval that are in a gray area. And that's where our condo team, Gretchen's team, is going to step in and say, okay, let's review a little bit further and see if we can make an exception for this. Or if you can give us one of these conditions, maybe that'll change the entire structure of the deal and we'll be able to continue working through it, right? There's a lot of things that are listed on there that really what we're looking for is just for it to make sense and to make sure that in the future, what we have as collateral, this property is still going to be something that is valuable, is still in good condition, right? That it's not something that we're just bypassing inspections. If there's health and hazard issues, we're just saying, oh, it's okay. We need to close this loan. No, we still have to adhere to certain guidelines. So just because it's non-warrantable doesn't mean it's, no rules. We just do whatever we want.
So we don't have expanded eligibility in the area of the building safety, and we still require all those documents. If the HOA has had an inspection in the last 3 years, we still require a copy. If they won't give it to us, then the project is not eligible. We have to review everything. We don't have expanded eligibility.
Yeah.
What we do have is we have the ability to make sense decisions based on those guidelines, where maybe there's something that we think that Freddie wouldn't purchase and Fannie wouldn't purchase. They have identical guidelines in that area. We might decide that we believe that based on those guidelines, we're not changing the guidelines, that it makes sense. I'll give you an example. The example I see most often is where there's been a building inspection. We have the evidence that the work has been completed. We've evaluated how it's been paid for, and they still have the code violation because they're a year behind in getting those cleared. So if we have a letter from a structural engineer that the work is completed, that it's safe for habitability, and we've evaluated any special assessments to meet guidelines, we would probably do that under the SMART product. I can't guarantee it. Again, it's very case by case. And that's why Cecilia is pointing this out. And then I want to go to litigation. So again, litigation, we still have the sort of misunderstanding that anything that doesn't meet warrantable guidelines, we can do in the expanded eligibility. And that is not the case. We're going to look at make sense litigation. So we're still not going to do any structural defect litigation with a developer. Those are not eligible under this product. We do not make exceptions for it ever. So the kind of litigation that we will do is when it kind of makes sense, but like it just doesn't fit into the warrantable space. So I give an example. The example I like to use a lot that comes up a lot is an HOA gets a contractor. They have 4 payments maybe to replace their roofs. They withhold the last payment because they don't feel that the contractor has met the terms of the contract. So contractor sues the HOA for non-payment, and now the HOA countersues them for not completing the contract. In the SMART space, we would ask for evidence that the HOA has these funds held in a separate account to pay this bill. Maybe it's $300,000 that the contractor is suing for, and the HOA doesn't want to pay because they feel like they haven't completed the work. Then we would probably do a loan in that project. So that doesn't fit in the Fannie Freddie space, but we'd probably do that in the SMART space. So it's really not a big lift. It's a little lift for very make sense litigation.
Yes. I love that, Gretchen, because you're absolutely right. We do get a lot of those scenarios. Yesterday, I was talking with a broker, and that was the exact scenario that they mentioned to me about that the work wasn't completed. And so then, there was like an argument or a fight basically between the builder and the HOA. And so now there's this litigation there. So they were asking me, is that something you can do? And I said, I'm pretty sure we can. We have to review it and make sure that, looks good. So I did refer them to the project team.
The
But
builder would be no. So if it's the builder, that's
Mhm.
structural defect litigation. If it's a
Yeah.
contractor to do one thing, for example, the roof, then we might do it. But if it's a
You might-
builder where they have a punch list of items that they say are not completed, we would not be able to lend in that project in this product.
yeah, it depends on how long that list is, right?
Anything with the builder, we're not going to be able to do.
Yeah.
So if it's with a contractor on an item, maybe they were supposed to replace siding, a siding contractor, a roofing contractor, an HVAC contractor, something like that, we would consider in the example I gave. But if it's a structural defect litigation with the original builder developer, we will not lend in that project. We don't have any space for that here.
Okay. All right.
That's-
And I know everyone has been hearing Gretchen say we can do that on the smart product, So if you're wondering, well, what is the smart product? The smart product is actually our non-QM. So everything that we've been talking about here today, all of our non-warrantable features, our condo tell features, these are all eligible on our smart series, which is our non-QM product group. And we've got a little bit of everything. We've done webinars before on our non-QM products, so you'll see them listed there. We have full doc options for those borrowers that were initially on an agency or conventional loan, and maybe the condo wasn't approved there, but it's non-warrantable, so they can easily pivot to our full doc product, Smart Edge. We've also got non-warrantable condos and condo tells eligible on our bank statement products, P&L, 1099, asset-based, as well as DSCR. So this is the space, the non-QM space where non-warrantable lives. Okay, so thank you everyone for joining us today.
And I'll just throw a plug out there, Celia, because the most frequent question I have out there is, do we have guidelines? Reach out to your AE. We have guidelines, but the point of this webinar is there's companies out there that consider non-warrantable condos just investor concentration. It's far more than that, but there's things that are absolute no's. Like Gretchen said, if you can't live in the property year round, we can't do it. Structural issues. So again, reach out to us. We have our project team, but call your AE. They have access to the guidelines. Then we can refer you to our project team for review. And yes, we will be posting this in the next few weeks, a copy of this webinar to our portal. So we appreciate everybody joining. Cecilia, I'll turn it back over to you, but thanks everyone.
Thank you, everyone. Thank you, Gretchen, for all of your expertise, answering all those questions and just going over that process. Yes, reach out to your account executives. They will guide you to where you need to submit all of your condo stuff. Again, we have a dedicated condo team called Project Review. They can review any questions that you have, any projects that you have. And again, thank you so much for joining us today. We'll see you next month. Take care.
Thanks everyone.
Bye.